Good evening and welcome to the Earnings Review, your tidbits into company financials and operational insights. Thank you for joining us as we broadcast from our Hampton Studios in Harare, Zimbabwe. I'm Ibn Mabunda, yo money man. On the show, we engage top echelon executives to get you up to speed with first-hand information. We also chat with the most competent analysts on the market just to ensure you're finished with relevant and comprehensive market analysis. Tonight, we focus on Truworths Zimbabwe, a listed clothing retailer on the Zimbabwe Stock Exchange. Now, let's just get into some of the details of interest in as far as the retailer is concerned. Now, the firm was incorporated in Zimbabwe in 1957 and has been operating as a retailer since then. Now, this is a firm that sells different international brands in the fashion wear as well as accessory segments, including Daniel Hester, the Truworths Man, the Ginger Mary, among other international brands. Now, the firm also distributes some of its brands through a local unit which is known as the Nachi. The firm was listed in Zimbabwe in the year 1981 with just 14 outlets spread across the country. Fast forward to the year 2020, the firm boasts of a footprint of over 64 outlets spread across Zimbabwe. Let's have a look at some of the firm's subsidiaries. It operates through the number one stores, Bravit Manufacturing, the Truworths chain, and of course the Truworths Management Services. Onto some vital stats where the firm is concerned. With a current share price of 17 cents, the group has a market cap of over 65 million Zimbabwean dollars. The stock has surged over 745% to date vis-a-vis a ZSE All-Share Index that has surged over 680% since the year started. In just a moment, we get into an earlier conversation that we had with the managing director of the firm, Mr. Ndebele. Now, don't go anywhere.
Equity Live presents the complete online interactive presentation solution. Hosting AGMs, media and analyst briefings has never been this simple, efficient and affordable. Communicate globally through a combination of high-definition video and your prepared multimedia presentation from any location of your choice. Interact with your invited participants from all over the world in question and answer sessions and voting sessions in real time on our safe, secure and affordable platform. Contact Equity Live for a free customized demonstration. Equity Live, real-time presentation solutions.
Now, joining us for a conversation over the phone is the Chief Executive for Truworths, Mr. Ndebele. Say good day and thank you for joining us on the Earnings Review.
Thank you.
Now, to get us kick-started, how are you faring with the pandemic?
Eben, the months of March and April were very difficult because we were classified as non-essential retail. Okay, so we were closed effectively from the 30th of March up to the 3rd of May. And then between the 3rd of May, when there was a partial review of the lockdown, we opened about 33% of the stores. And then on the 15th of May, that's when we started opening all the stores, So, if you look at, the review period, you actually have got a good 6 to 7 weeks where we had absolutely no revenue at all.
Now, of course, this conversation is coming shortly after the publication of your results for the period ended the 6th of July 2020, which would pretty much spell your full year results. And just to get into some of the details that are highlighted in that very publication, according to the results, your revenue dipping marginally in inflation adjusted terms from 177 million Zimbabwean dollars to just about 160 million dollars. Just in a nutshell, can you give us what informed that performance and also to touch on your volumes, which dipped by more than 57%. Over to you.
Okay, look, the volume decline was partially attributable to the 7 weeks that we did not trade. Okay,
right.
And then secondly, before we went into COVID, this economy was already on a decline. and aggregate demand was very low. Okay, and what COVID did was exacerbate the situation. You know.
Okay.
Mm-hmm. And then, what does it mean in terms of your cost structures? Our biggest costs are employment costs, followed by occupancy costs, and so forth. And during that lockdown period, because it was not the fault of the employee, our employees, we paid them their full salaries. Okay, we paid full rentals to the landlords. Okay, and because the statutory instruments that gave rental concessions here only applied to residential, it did not apply to commercial properties. Okay, this was unlike countries like South Africa and the UK, where there was a stimulus package that effectively looked at, all those costs to assist the retailers or business during that lockdown period. Okay. But so you lose your turnover, but your cost structures are remaining the same, and then that obviously depresses your earnings, Okay, but having said that, we still came out fairly strongly. We still came out profitable, and you can see from the results that we reduced our borrowings, and our borrowings were fairly minimal, And for a business that was running on a credit model, we think it was a reasonable outcome under the circumstances.
Now, you just indicated the idea that you had to tweak your working capital and cut back on your credit sales. Can you shed light on that very initiative?
When we had the introduction of the bond note, okay, there's two things that we actually did. We basically said to ourselves, we will not have any open foreign creditor positions, because we anticipated that the currency was going to depreciate. Okay, I mean, the bond note had been, introduced on the basis that there was insufficient US dollars to drive the economy. Although that was not the reason. It was an export incentive. But I mean, we all know that this economy did not have sufficient dollars. Okay, so that lack of foreign currency exposure preserved our balance sheet, okay, and our cash, because if you were exposed, then with the devaluations that have taken place, you would have decimated your balance sheet, okay. And then 18 months ago, when we started experiencing inflation and into hyperinflation last year, we took a strategic decision to reduce the granting of credit, okay, or to have an expansionary credit model, because as you understand, the minute you sell and you've given someone terms, okay, and the rate is going, you are dead and buried before you even get the money, okay? So you'll see that we then strategically say, look, we will drive the business towards cash sale. Okay, and then in that reporting period, our cash sales to total sales ratio came up to 51.9%, which helped on the liquidity. Okay, we've just issued a trading update, and for the last quarter, the last 3 months, our cash sales are now 68.5% of our total sales. Okay, as we move the business more towards a cash model rather than credit. I mean, credit in hyperinflationary conditions is very difficult. But at the same time, we haven't completely shut the door on credit, because for our good customers and our loyal customers, we still grant credit judiciously, but there's now a cost of credit in the form of, the interest charges, on the outstanding balances, on a monthly basis. Okay, and those interest charges are aligned to the lending rates.
Now, you have a manufacturing segment, the Brevet unit, where you have some components that are actually imported. At the same time, you've got some of the brands which are imported from different destinations, including South Africa. Given the foreign shortages that are playing out in Zimbabwe, how are you sourcing for the forex?
Well, what has happened since June is there's been, the auction market or the currency allocation, centralized currency allocations, whatever you call it, okay? And we have been successful in putting in applications for the sourcing of our raw materials from the currency auction system, okay? And then two, when you look at finished product, because we've been allowed to sell in US dollars, we are generating currency, to bring in imported finished product from our sales, Although at the moment with depressed demand, that is not, the foreign currency trading in terms of customers is still not huge, okay? But with the volumes that we are actually doing because of the slowdown or collapse of aggregate demand, it is sufficient to keep us going.
Now, as we are readying for the festive season of 2020 to 2021, how prepared are you in terms of making sure that you meet the anticipated surge in demand over the period?
We are sufficiently stocked for the festive season.
I realize.
Okay. And the timing of the auction was actually perfect for our business because the auction started in June. And in June, that's when you are actually bringing in your raw materials for your Christmas trading, so it actually came in handy, okay? So in terms of our merchandise planning, we always work a minimum of 6 months ahead. What we are worried about at the moment, not worried about, what we are working on at the moment, and we've already placed orders and they're coming through, is winter next year.
Talking about the COVID period, you also, of course, played in terms of manufacturing some face masks. How significant in terms of contribution to revenue was that very initiative?
We did quite a bit of face masks because I think in the month of April, the factory, operated for the whole month, albeit at reduced staffing levels, to try and cope with the face masks demand. And our face masks were not for retail. Most of our face masks were for corporates, especially companies that were deemed to be essential business, and they had to buy that PPE for their staff, okay? But I mean, you got to understand that it's a low value product. It's a low margin product, and it was never our intention to be Bill Gates out of producing face masks.
Now, to get into another subject, how are you faring with the competition within your segment, and how are you defending your position within the market, given the fact that there has been also the entrance of other players into your segment, particularly in the more affluent suburbs of the metropolitan areas in Zimbabwe?
With Truworths, in terms, if you look at fashion retail chains, we have no competition at that level. We've got competition from boutiques and all that sort of operator. But you must remember that a lot of boutiques, it's a one-man store in a particular area, and it's not spread throughout the whole country, okay? Right, if you look at that area, one of the biggest competitive advantages that we have had on that over the years has been that most of those boutique operators were not giving access to credit, okay?
Correct.
And we built a customer base based on access to credit, okay? All right, so in that premium end of the market, we were offering credit, okay? But now we are priced competitively with some of these boutiques and that sort of thing, okay? But again, at times you ask the question that, is it a level playing field or not? Are there duties paid on some of that merchandise imported by the boutiques? Okay, right? Are they genuine brands or are they fake brands and all that sort of thing, you know? So for the discerning consumer, they obviously stick to the brand that they know and the brand that has proven itself over time, you know.
Now, in terms of making the playing field fairer for significant contributors as Truworths, Edgar's, the list being interminable, how can government make the playing field fairer?
Okay, right. Let me answer that question. For us, from a manufacturing perspective, okay, all non-cotton fabrics that we import for manufacture or for apparel in this country is duty-free. Okay, we don't pay duties on that, which is a big incentive and a big saving. Okay, right? You know, so we addressed those issues with government a while ago, and I think in 2016, 2017, that you know, that was introduced. In 2018, it was even expanded and so forth. Okay, so there has been, government has played its part by eliminating duties on imported raw materials. Okay, what we actually want to see from government now is the enforcement of duties on finished product coming into the country.
Right.
You know? Because we don't believe some of the goods that are being sold, okay, the duty, you know, the pricing doesn't show that any duty has been paid, you know. And us, when we import finished goods, being a form of business, we pay our duties and we pay our taxes. So we would like to see enforcement on the smuggling of goods into the country.
Now, can you give us a breakdown in terms of the revenue contribution of some of these of your brands, as well as maybe shedding light in terms of the catering of the different market segments that we have in Zimbabwe?
Topics is still 50% of our business. Number one is 15% of our business. You know, what you've actually seen in the intervening years, number one has always been our mass market brand, okay? And number one was built on agricultural and rural areas and mining areas. After land reform, you know, there was no purchasing power and no spending power in those areas because all those farm workers, you know, lost their jobs and the state, you know, and so forth, okay? And then number one is now more on the urban side. And as you can see, if you go back 20 years, there was no number one crossing Julius Nyerere into First Street or you know, if you look at it now, we've got a lot of number one stores coming into those areas, and our biggest are now coming into those areas. Okay, and then your rural stores, they have obviously suffered with the advent of land reform and that sort of thing. Okay, Topics has always been strong. It's a family store, and one of the biggest things is the quality in Topics. Okay. We haven't compromised our quality. You know, it's still a very strong brand driven by quality and the family store, okay? And I'll challenge you in that market segment to go and buy a product from Topics and go and buy a product from our competitor, and you tell me which one is of the better quality. Okay? What we've basically said is Topics, we're not a mass market retailer, right? But now, where has Topics been affected negatively? Topics was affected negatively in the late 90s and 2000s with emigration. Are you with me? Okay?
Right.
People who emigrate, it's not unproductive. Old people who are retired and young people, it's the productive, you know, okay, sector of your economy that emigrates. Okay? And we lost a lot of customers during that emigration period, you know. Okay. A lot of young people and that sort of thing, you know. In particular, teachers, your teachers love the Topics brand and they still love it up to date. Your nurses and all that sort of thing, you know. Okay.
Of course, you are boasting of a footprint of over 64 outlets that are spread across Zimbabwe. Are there any plans to expand your footprint across the nation?
If there is economic growth, we'll obviously open more stores. Okay, but if there's no economic growth and the incomes carry on as they are, it doesn't make any iota of sense to open more stores because you will not achieve the trading density.
So strategy then becomes preservation of value and ensuring that you continue to steer profitably.
You're going to trade profitably, yeah. There is no point in having these ivory towers or these white elephants, for the sake that I've got that when you are losing money,
In conclusion, Mr. Ndebele, can you give us your 2 to 3 year outlook for Truworths Zimbabwe?
Look, where we are at the moment is you're going to trade profitably. One,
correct.
Preserve the balance sheet. Two, and you've got to have the cash flows to do that. Okay? And hoping that things will get better. When things get better, there is still opportunities, okay? And massive opportunities, okay? For expansion of the brand.
I realize.
Yeah,
I realize.
Yeah. So there is still, we've been through this cycle before. I mean, in 2005, 2006, 2007, we closed a lot of branches when we had the first bout of hyperinflation. From 2009, when things stabilized, we reopened a lot of these stores, okay? And I'll give you an example. If you go back in the second year of dollarization and look at what we did then, okay, it will give you an indication of the potential, the latent potential that is being withheld by the economic conditions in this country.
Mr. Ndebele, the Chief Executive for Truworths Zimbabwe, thank you, sir, for joining us on the earnings review. Now, in the next segment, we'll be getting into an independent analysis of the operations of Truworths. Now, don't go anywhere.
Equity Live presents the complete online interactive presentation solution. Hosting AGM's media and analyst briefings has never been this simple, efficient, and affordable. Communicate globally through a combination of high-definition video and your prepared multimedia presentation from any location of your choice. Interact with your invited participants from all over the world in question and answer sessions and voting sessions in real time on our safe, secure, and affordable platform. Contact Equity Live for a free customized demonstration. Equity Live, real-time presentation solutions.
Thank you for staying with us. Now, in this particular segment, we get into an independent analysis of the operations of the clothing retailer. And joining me on set to discuss their operations is the Chief Analyst for Equity Access, Respect Kwenzi. Respect, good evening, and thank you for joining us on the earnings review.
Thank you, Eben. It's my pleasure to be here.
Beautiful. To sort of hit one or two notes that we discussed earlier on with the chief executive, their volumes over the period in question actually took a 57% to 60% decline over the period in question, which is a phenomenon that we find common across the sector. There at the time we're talking about Edgar's, and they have got double-digit margins in as far as the decline trajectory is concerned. What do we read from this particular development as well as other developments actually affecting this very sector?
Thank you. So for the period under review, I think it's not very surprising to see companies reporting such huge loss margins in terms of volumes. Like you mentioned, it's a sector-wide phenomenon. We're seeing it elsewhere. We're seeing it in competitors, notably Edgar's, which is also listed. But you also got other apparel retailers as well who are reporting a similar trajectory as well. So I think it's something that we have been seeing in this market, but it has been made worse getting into 2020 by some other dynamics. But coming from 2019, the key variable there is inflation, which has chewed into disposable incomes, and therefore consumer spend has really gone down. If you look at the 2019 numbers in terms of GDP, we're down by 10%. That's really huge. We haven't suffered such a decline since 2008. So I think it's a very serious it's a very serious thing. So I think getting into 2020, we see COVID kicking in, and it reduced the number of footprint into some of these shops. So it also dragged demand down. And now that lockdowns are being relaxed, and we're now seeing a return of demand, but then not to levels that we're seeing pre-lockdown levels. So I think these are some of the key phenomena that arose over the period to impact on performance. So that's why we're seeing that double-digit decline.
In the same bracket, credit sales also form an integral part of their revenue generation, and they have actually had to reduce and cut back on the credit sales that they actually issue out to the public on the basis of the inflation that still remains very much unbridled. What do we read from that?
Yes, I think that's a tactic in an inflationary environment. You try to mitigate the impact of inflation. Why? Because once you give someone money, someone or credit, what happens is that when they pay back, say after a month or two, the value of that money would have depleted more significantly beyond the interest rates that you're charging. So on the net, you expect the person who is giving you the loan or who is pushing their sales on credit to be making a loss if the interest rate on the apparel that they're selling or at credit, or the money that they've extended to you, it has got an interest rate which is lower than the prevailing exchange rate. So with inflation rates of about 850 year on year as at July, and obviously month on month averaging above 15%, it's very difficult for one to run a profitable credit model. This is why we saw Truworths coming there, strategically reducing the exposure to credit sales, because on the net you are actually losing out when you sell more of your sales in credit in an inflationary environment.
Now, this conversation, of course, is coming in a fortnight after the release of the 2021 budget by the Minister for Finance, Professor Ndebele. And there are particular developments that would, I believe, would have some kind of a bearing in terms of Truworths as well as other players within this particular sector from a macroeconomic perspective. On the one hand, you have a tax regime which some have criticized as being punitive, given the fact that the country has suffered a couple of years in the doldrums from a GDP perspective. Then you have, on the other hand, some form of tax strategies that have been put in to tax the informal sector, which in one way or the other were proving to be a competitive force against some of these players like Truworths and Edgar's. What is your assessment of the budget and its bearing or implications or ramifications in as far as Truworths and players within the sector are concerned?
Yeah, I think the implication is double-barreled. You have a broadly expansionary budget that was released a fortnight ago. So the implication there, on the outset, is that you might see expenditure moving up. Why? Because the budget has now been increased by more than 100%. So you expect spend to go up if other things such as inflation remain constant. So what that does is to drive sales volume across the economy up. So for apparel, which normally is right at the lower end of the value chain, you realize that consumers will now start to consume those kind of exigencies on not so much of important products. Again, you would name insurance and so forth and so forth. So I think we'll see demand coming back into their space broadly. But then there are other critical issues there to say. There are other forms of taxation, such as the one that's targeted at the informal sector. But if you also go back a bit and look at 2019, when IMMT was introduced, it was also targeted at tapping into that informal market where people trade highly through their phones, which is mobile money. So you find that sector contributing a huge chunk of the country's taxation, a double-digit figure in its first year. So that was huge. It really helped stabilize or improve the income that was collected for that year. So into 2020, looking at the structure of our economy, 60+% in terms of the informal sector, there is definitely that need from a strategic point, from a policy point, to try to see what value can be tapped from this highly informal market. Because when you have such a high or a big informal market, there's risk of losing money if people don't pay taxes and whatnot. So this form of taxation obviously is likely to push the broader earnings from a government perspective up, and if channeled properly into some key areas such as some investments, road infrastructure and so forth, it could yield long-term benefits. But now looking again into the retail space and seeing that some of these, there's a proliferation of these small players doing their small stores, around town, and also some doing it virtually, you realize that such a taxation could obviously increase the cost of their doing business, and it would also reduce the cost of their merchandise. And this reduces competition really, because some of these operators, they just place their stores in front of key competitors such as Truworths, and they're selling much of their stuff out there. They're not paying rent, they're not paying for taxes, they're not paying power and so forth. So their costs of operating their business
quite minimal.
Yes. So now that you have this form of taxation and you have to add it to your costs, it also closes the gap on what we are seeing, being incurred by some of the big players. So that's a benefit to the traditional players. So I think the implication is quite varied depending on the angle you're looking at, but it's likely to cause a bit of a shift and to improve the competitiveness of the traditional players such as Truworths and Edgar's, of course.
Well, thank you, Respect, for the insights. Thank you for staying with us. Don't forget to follow us on Facebook, Twitter, and to visit our informative website, www.equityaccess.net. Remember to catch us every Tuesday, every Thursday, 7 p.m. Central African Time on this very platform. From the Equity Access team and I, Danky, and ciao.